Imagine for a second that you are a field commander,
Yeah.
right?
Okay, I'm with you.
And you're trying to coordinate this massive swarm of autonomous drones over, I don't know, a contested region in the
Like
Pacific.
super high stress environment.
Exactly. And suddenly your satellite uplink is just completely severed.
Right, gone.
Yeah, gone. Your communication systems are actively jammed by an adversary. You are totally cut off.
Which is the nightmare scenario for the military today.
Total nightmare.
Yeah.
You need a highly secure, localized network to process all this targeting data right there in the dirt.
Yeah, in real time.
In real time, exactly. Without relying on some pristine data center thousands of miles away in Virginia.
Right.
So the question is, who do you call to build that brain?
Well, historically, you definitely wouldn't call a 112-year-old accounting and consulting firm.
You wouldn't. But today, incredibly, that is exactly who is answering the call.
It really is wild.
Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Booz Allen Hamilton, trading under the ticker BAH.
BAH.
BAH is executing a deliberate, high-margin corporate turnaround, intentionally shedding legacy civilian consulting contracts to pivot its business model toward owning proprietary combat connectivity software and hardware. However, this strategic pivot creates a structural tension, creating a temporary margin valley that has depressed the stock while the firm builds an unassailable interface moat for the future battle space.
I mean, it is just an incredibly ambitious corporate evolution.
It really is.
They were watching a massive company essentially try to rewrite its own genetic code.
Yeah.
And they're doing it in real time, right in front of public markets, which is never easy.
So let's unpack this mission for you, the listener. You might think of Booz Allen as, the ultimate trusted advisor.
Right, the guys in the sharp suits.
Exactly. Sending armies of brilliant, highly cleared consultants to the Pentagon to just provide brain power.
Provide strategy, write reports, yeah.
But today on this deep dive, we are going to explore how they are radically transforming into what they call a product-owning cognitive prime.
A cognitive prime, yeah. It's a massive shift.
And we need to figure out what this pivot actually means for the staggering $38 billion backlog they are sitting on right now.
$38 billion. It's a mountain of cash.
It's unbelievable. And ultimately, we need to determine whether their current stock dip is just a classic value trap or maybe, just maybe, the ultimate entry point for your portfolio.
Right, because if you are an allocator...
Or a portfolio manager.
Yeah, or just an investor trying to navigate the defense tech sector right now, understanding this shift is crucial.
You have to get it.
You need to understand the mechanical difference between their legacy consulting revenue and this new high-margin product revenue. It is non-negotiable.
Absolutely non-negotiable. So this deep dive is designed to give you the exact framework you need to evaluate Booz Allen's upcoming earnings call.
Because right now, I mean, the market is fundamentally mispricing the friction of this entire transition.
Wall Street is highly confused by this.
They are.
I mean, we are looking at a defense giant trading at roughly 10 times forward earnings.
Which is so low.
Right. For a company with their kind of entrenched government relationships, that multiple is surprisingly low.
Yeah, it really is.
But to understand why the market is struggling to price this stock, we really need to look at what Booz Allen is actually buying.
What they're buying to construct this interface mode, right?
Exactly. So let's look at their core operating strategy. Management calls it VOLT. That's V-O-L-T. Velocity, Leadership, and Technology.
Yeah, VOLT. It's basically their internal playbook for moving up the defense value chain.
Okay, unpack that for me. How does VOLT actually work in practice?
Well, historically, if the military needed, say, a new secure network, Booz Allen's quote-unquote technology offering meant just deploying a massive team of consultants.
Right, billing by the hour.
It's exactly a time and materials business model. They would analyze the problem, write a thick report, and recommend which third-party tech the government should buy.
Buy from someone else, you mean?
Right, buy from another company entirely.
Yeah.
And maybe Booz Allen helps plug it in, but they didn't own anything.
So VOLT changes that.
VOLT completely flips that script. Now, it is all about co-innovating with commercial tech partners and, honestly, using strategic acquisitions to build, own, and sell the actual technology themselves.
Okay, I hear the theory, but let's look at the actual practice here. the clearest signal that this Volt thing isn't just, a corporate whiteboard exercise.
Really, just buzzwords.
Yeah. The proof is this massive catalyst from June 22nd, 2026.
Oh, the Ultra acquisition.
Yes. Their $720 million all-cash acquisition of the Ultra I&C Mission Solutions business from the Taubman Ultra Group.
It's a huge deal.
$720 million in cash is a massive statement of intent.
Unmistakable.
But wait, I have to ask. They bought an engineering and hardware business. Since when does a century-old advisory firm know the first thing about manufacturing ruggedized silicon?
I know, right?
I mean, that just sounds like a massive integration disaster waiting to happen.
And honestly, that is the exact structural skepticism keeping the stock price down right now.
Because it's a valid fear.
It is a completely valid fear. Hardware is brutal. I mean, supply chains, physical manufacturing facilities.
Quality control.
Quality control, exactly. All of that requires a completely different operational DNA than just managing human capital and sending smart people to meetings.
Right.
But if you look closely at what they actually bought with Ultra I&C, it makes more sense.
Okay, what did they actually buy?
Well, they didn't buy a massive shipyard, or a huge missile factory.
Thank goodness.
Right. They bought the critical, highly specialized infrastructure of modern digital warfare.
Okay.
There are 3 specific product lines in this acquisition that I think fundamentally alter their entire business model.
All right, let's break those down for the listener. The first line the sources point to is mission software.
Right, mission software. Think of this as the digital nervous system of the battlefield.
So not just basic IT.
No. We are not talking about back office, payroll software, or HR portals. This is AI-enabled command control software. C2.
C2, right.
This is software sitting right at the tactical edge. It takes all these disparate data feeds.
From like satellites and stuff?
Satellites, drones, ground sensors, you name it. It pulls all that data in, analyzes it instantly using AI, and helps actual warfighters identify targets and make lethal decisions in real time.
Wow. Okay, so software makes total sense for a tech-heavy consultancy. I get that.
Right.
But the second piece here, edge compute, this is where I get tripped up.
The hardware side.
Yeah, why physical hardware? Like, can't the military just run this fancy AI software on a Panasonic Toughbook or just beam it back to a massive Amazon Web Services server in Virginia?
Well, I mean, in a perfect peaceful world, yes, absolutely. But in a contested environment against a peer adversary, like China or Russia, absolutely not.
Because they'll just jam the signal.
Exactly. The moment a conflict starts, those adversaries will attempt to jam all communications. They will try to sever that pristine link to those nice air-conditioned AWS data centers in Virginia.
So you need the computer right there with you.
You have to have it. Edge compute means putting high-performance physical processing power right there in the dirt.
Literally in the dirt.
In the dirt, on the Humvee, or bolted onto the drone itself. And that hardware has to be ruggedized.
Meaning it can take a beating?
It has to survive extreme heat, intense vibration from being in a vehicle, and even kinetic blasts. The military needs the actual physical server to be present on the battlefield so the mission software can run locally.
Without needing a signal to call home.
Exactly, without calling home.
Okay, that makes sense. Which brings us to the third line of the Ultra I&C acquisition, encryption management.
Which is crucial.
Which I assume is basically the lock on the door for that local server you just described.
It's the lock, it's the vault, and it's the guard dog all rolled into one.
Right.
It provides secure, anti-tamper data movement. Because think about it, if you have the best AI targeting software in the world, running on the toughest localized edge hardware, it is entirely useless if the adversary can just intercept the signal, spoof the data, or worst case, physically rip the hard drive out of a downed drone and read your code.
Oh, man.
Yeah,
if a drone crashes and they just take the computer.
Exactly. So Ultra I&C brings modular hardware-level encryption that physically secures the data flowing across these systems.
Hardware level, so it's built in.
Built right in. If the device is tampered with, the data zeroizes. It basically self-destructs the information.
Wow. Okay, I see the whole picture now. This is what industry analysts are calling the cognitive prime pivot.
The cognitive prime, yes.
Because Booz Allen already had elite cybersecurity and AI capabilities in-house, right?
Oh, massive capabilities, like their Velix AI-native cyber suite, for example.
Right, Velix.
Yeah.
Which uses machine speed automation trained by their top cyber operators. Exactly.
But what they are doing now is embedding that proprietary Velix intelligence inside the encryption hardware and edge processors they just bought from Ultra.
That's the magic trick. By owning the hardware, the encryption, and the software, They transition away from being just a service integrator.
They become a true cognitive prime.
Right. They are no longer just advising the military on how to build a network. They are physically supplying the secure data backbone that connects the sensors to the actual weapons.
The connective tissue.
Yes. And this shift from services to products, I mean, this is where the financial math just becomes totally explosive.
Let's talk about that math, because if you are an allocator listening to this deep dive, you are looking for a return, not just a cool technology sci-fi story.
Exactly. And the math here comes down to one thing: margins.
Under the legacy consulting model, you are effectively just renting out human beings by the hour, right?
Yes, and there's a very hard ceiling on how profitable that can be. You can only bill so many hours in a day.
But when you shift to proprietary product ownership, you unlock highly scalable, recurring revenue streams.
Because you build it once.
You build the software once, you manufacture the edge processor design once, and you sell it 1,000 times to the government.
And Booz Allen's management has been pretty vocal about this, haven't they?
Very vocal. They have explicitly targeted EBITDA margins well above 20% for this new product portfolio.
Well above 20%. That's huge. Let's compare that to their overall corporate adjusted EBITDA margin, which was sitting at, what, 11.1% in the fourth quarter of fiscal 2026?
11.1, yeah. So they are aiming to practically double their profit margin on this new line of business.
Double it. That is wild. So instead of billing the Pentagon $200 an hour to write a report on network security,
Just takes months.
right. Instead of that, they're just selling the Pentagon the proprietary encrypted router and the software licenses to run it.
It's a completely different business. But, owning the technology is really only half the battle here.
Okay, what's the other half?
To actually achieve those 20% margins, you have to ensure the government actually buys it and standardizes it across the force.
You have to make it essential.
Right. You have to integrate your technology alongside the other massive defense contractors so deeply that you become entirely indispensable.
You have to become the operating system.
Yes, they're positioning themselves to be the cognitive operating system of the military.
So to understand how they become this operating system, we really have to look at this fascinating concept of co-opetition.
Co-opetition is such a great term for this.
It completely changes how we view their place in the ecosystem. I mean, look at their relationship with Palantir.
Palantir is the perfect example.
Everyone knows Palantir as the heavyweight data analytics software engine for the U.S. government.
Massive player.
On paper, Booz Allen and Palantir should be mortal enemies, right? Fighting tooth and nail for the exact same federal IT budgets.
Oh, they definitely compete in certain areas, but they also desperately need each other.
Why do they need each other?
Because Palantir operates on a very strict software-first model. They build massive proprietary data integration platforms.
Like Gotham for defense.
Right, Gotham.
Yeah.
Or Foundry for their commercial clients. But their entire business model relies on product-led growth. They want to scale the exact same piece of software across as many clients as possible.
With minimal tweaks.
Exactly, with minimal bespoke custom engineering. Because custom engineering requires a lot of human hours, and that destroys software margins.
Ah, I see. So Booz Allen steps in to do all the messy, bespoke integration work.
Precisely. Palantir provides the incredibly powerful software engine, but Booz Allen builds the highly customized architecture around it for the specific client.
So Booz Allen acts as the expert integrator.
Yeah, they have these hyper-classified intelligence agencies adapt Palantir's broad platforms for incredibly specific niche mission needs.
But here's the brilliant part of the strategies, right? While they're integrating Palantir, Booz Allen is simultaneously weaving in their own proprietary technology.
That is the Trojan horse.
They integrate their SITX mission software, right?
Right.
And their dynamic effects tasking system, DETS, for cyber operations, and all their zero trust cybersecurity solutions.
They weave it all together.
Yeah.
And then they're deploying this entire integrated stack onto edge hardware built by other disruptive defense players.
Like Anduril.
Yes, Anduril is a great example.
Yeah.
The sources highlight how Booz Allen integrates their command and control capabilities directly onto Anduril's Menace compute systems.
The Menace. It's honestly a genius strategy. They are literally making themselves the connective tissue of the modern military.
It really is.
I mean, think of it like Apple's iOS ecosystem, right?
I love that analogy.
Lockheed Martin or Anduril might build the physical, quote-unquote, iPhone, the metal, the hardware.
Right.
But Booz Allen wants to own the iOS. You can swap out the physical phone for a newer model, but you are absolutely locked into the operating system.
It is the perfect analogy. And to truly crystallize what Booz Allen is becoming, you have to contrast them with what they are intentionally choosing not to do.
Let's talk about their competitor, Leidos.
Oh, this is a wild contrast.
It is. While Booz Allen is spending $720 million to buy AI software and edge processing from Ultra,
Leidos is going a completely different direction.
Leidos just dropped $2.4 billion to acquire Entrust.
Right, Entrust.
Leidos is moving heavily into massive industrial energy infrastructure, heavy systems integration, and kinetic hardware manufacturing.
Yeah, they were literally building air defense launchers and actual components for hypersonic weapons.
So we are witnessing the real-time stratification of the defense tech industry here.
We absolutely are. Picture a Leidos engineer in some massive facility, literally welding the titanium casing for a hypersonic missile.
Bending metal.
Bending metal, that is the kinetic prime. They are the muscle, the heavy industrial hardware.
Okay, the muscle.
Now, picture a Booz Allen developer writing the AI autonomy algorithms that tell that Leidos missile where to fly when its GPS is jammed by an adversary.
Wow.
Booz Allen is cementing itself as the cognitive prime. They are the brain.
Hypersonics versus brains. And the financial profile of those two strategies, I mean, it couldn't be more different.
Night and day.
Building missiles is incredibly capital intensive. You need massive factories, specialized raw materials, vast labor forces. It generally operates at significantly lower structural margins.
It's expensive and risky.
Whereas Booz Allen's combat connectivity software, like we said, commands those scalable, high-margin revenue streams.
And you can actually see them doubling down on this brain strategy through their venture capital arm, Booz Allen Ventures.
Let's look at that VC arm.
They actually tripled the size of that fund to $300 million last year.
$300 million, wow.
And they are aggressively using it to buy into deep tech that reinforces this cognitive dominance.
The sources list a couple of fascinating examples of these investments. Take Node AI.
Node AI is super interesting.
They focus on multi-domain autonomy orchestration.
Which is a mouthful.
It is a total mouthful. Basically, from what I understand, they build a vendor-agnostic platform that lets a military commander coordinate massive swarms of different autonomous vehicles.
Right, all at once.
So you have drones in the air, robotic subs in the sea, rovers on the ground, all acting as one unified ecosystem.
Exactly. And the key is that Booz Allen doesn't want to actually build the drones or the subs.
Bending the metal again.
Right, they let someone else bend the metal. They just want to own the software that commands the swarm.
Another crucial investment from that venture fund is Portal Space Systems.
Specifically, their Starburst and Supernova platforms.
Right, and this is all about orbital maneuverability.
Space is becoming a massive, contested warfighting domain.
Absolutely.
And satellites need to be able to dynamically reposition themselves in real time to avoid attacks or optimize coverage.
Right, you can't just leave them sitting there.
No, they have to move. So Booz Allen is investing in the cognitive systems required for those high-stakes, real-time space operations.
So if they successfully pull this off, if they actually end up owning the data backbone and the cognitive operating system of the military,
The switching costs become astronomical.
insurmountable.
Yeah.
Traditional kinetic primes, the massive companies building the missiles and the jets, they will be forced to plug their hardware into Booz Allen's interface layer.
That is the ultimate definition of an interface mode. I mean, you can always fire a vendor and buy a different branded drone, right?
Sure.
But trying to rip out and replace the underlying digital nervous system that connects your entire joint force across land, sea, air, and space,
It'd be chaos.
it is nearly impossible. It forces a permanent structural reliance on Booz Allen.
Okay, I see the vision here. High margins, incredible switching costs, positioning themselves as the indispensable brain.
Sounds great, right?
It sounds amazing.
Got it.
But if this cognitive operating system is so bulletproof, why am I looking at an income statement where their top-line revenue just shrank by 6.5%?
Ah, the reality check.
Right. Moats are supposed to make you money, not lose it. We have to do a forensic audit of these contract roll-offs.
Yeah, this is where the soaring narrative of a corporate transformation collides violently with the cold reality of public financial markets.
The numbers don't lie.
They don't. When investors look at the fiscal 2026 numbers, the surface optics are just grim.
Grim is an understatement, honestly.
Yeah.
The Q4 FY26 numbers show a 6.4% full-year revenue contraction.
Down 6.4.
Total gross revenue for the year settled at $11.2 billion. But the bleeding is incredibly concentrated in one specific area.
The civil segment.
There was a brutal 23% year-over-year decline in their civil business segment in the fourth quarter.
23%.
23% of a massive segment just gone.
So we have to unpack the mechanics behind that massive drop because it is a very complex mix of intentional corporate strategy and a devastating unexpected shock.
Let's start with the intentional part.
Okay, remember the quote-unquote margin valley we mentioned in our thesis?
Yes, the margin valley.
Booz Allen is deliberately pruning lower margin time and materials service contracts from their portfolio.
They are actively choosing not to renew them.
Exactly. They're willingly walking away from legacy consulting work that just doesn't fit the new, highly profitable cognitive prime profile.
So when you intentionally shrink your historical base to build a new one, your overall revenue naturally dips.
Right. That is the valley.
I understand the strategy of pruning the deadwood. I get that. But a 23% drop is not just pruning.
No, it's not.
The decline was severely compounded by massive, unplanned losses. And we have to talk about the Treasury Department data leak.
The insider threat contagion.
Now, before we dive into the mechanical details of this, I want to be perfectly clear to our listeners.
This is important.
We have a strict impartiality rule here on the Deep Dive. We are going to discuss a highly publicized incident involving the leak of former President Donald Trump's tax returns. We are absolutely not taking any political sides regarding the figures involved.
None whatsoever.
We are not taking a stance on the associated lawsuits or the broader politics of tax transparency.
Exactly.
We are strictly, purely, mechanically analyzing the financial impact this specific event had on Booz Allen Hamilton as a publicly traded prime contractor.
Understood. Our lens here is purely focused on risk management and financial modeling.
So give us the context. What happened?
The context is this. Between 2018 and 2020, a former Booz Allen contractor named Charles Littlejohn illegally accessed and leaked highly confidential taxpayer data.
Including the president's data.
Yes, including the president's, to various news outlets. He was subsequently caught, convicted, and sentenced to 5 years in federal prison.
Okay, so that was the crime, but the financial fallout for Booz Allen arrived a few years later.
It was a delayed reaction, but a massive one.
In January 2026, the Treasury Department, under Secretary Scott Bessent, took what I think is the unprecedented step of entirely blacklisting Booz Allen.
Blacklisted. They didn't just fire the one contractor who committed the crime.
No. They canceled all 31 of their active contracts with the entire firm.
Every single one. And the mechanical impact of that mass cancellation was immediate.
What were the numbers?
It instantly wiped $4.8 million in annual spending right off Booz Allen's income statement, and it removed $21 million in total contract obligations from their books in a single stroke.
Just erased.
Erased. And Secretary Bessent publicly cited a complete lack of confidence in Booz Allen's ability to screen, vet, and safely deploy contractors into sensitive government environments.
Ouch. That statement right there, that lack of confidence, that is the core issue for this entire company.
It is the existential threat.
Because Booz Allen's entire legacy business model relies on what they call mission intimacy.
It's intimacy, yes.
Let's explain that. How does mission intimacy actually work physically?
It means Booz Allen gets its employees top secret clearances and then physically places them at desks inside government buildings.
Right, inside the Pentagon, the CIA, the Treasury.
Exactly. Sitting shoulder to shoulder with actual government officials, they have access to everything.
So if the Treasury is willing to entirely blacklist a massive contractor over an insider threat, the contagion risk is terrifying.
Oh, it's the biggest risk they face.
What happens if the Department of Defense wakes up tomorrow and decides they also no longer trust Booz Allen personnel wandering around their buildings?
That is the single biggest reputational vulnerability the company faces. The Treasury cancellation sets a really dangerous new precedent.
It shows that it's possible.
It signals that federal agencies are now willing to hold prime contractors strictly financially accountable for the security hygiene of their entire massive deployed workforces.
Right. A single human failure by one individual contractor triggered a total loss of trust from an entire federal department.
And if that anxiety spreads to the intelligence community, the foundation of the company just crumbles.
Have we seen any evidence in the data that the contagion actually has spread beyond the civil segment?
Well, thus far, no. The financial data suggests the bleeding has actually been contained.
Okay, good news.
If you look at their national security portfolio, which houses their highly classified defense and intelligence work, it actually stabilized.
It didn't drop.
It grew 1.6% year over year in the fourth quarter, and that was driven by sustained demand in their intelligence sector.
Interesting.
Furthermore, management is actually projecting mid-single-digit growth for that national security portfolio moving into fiscal 2027.
Okay, so the civil business is bleeding heavily, dragged down by the intentional pruning we talked about, plus the Treasury shock.
Right.
But the national security side is holding the line. Yet, paradoxically, their backlog of future work has never been higher.
It's sitting at absolute record levels.
How on earth do we reconcile a shrinking top-line revenue with a literal mountain of future contracts? Let's unpack the backlog paradox and conversion friction.
Yes. This is, honestly, the most complex dynamic in the Booz Allen financial narrative right now, and it's the exact reason the stock is mispriced.
Break it down for us.
You have a company reporting a 6.4% revenue contraction for the year,
Right.
while simultaneously sitting on a record $38 billion total contract backlog.
$38 billion. And I want to point out, this isn't just theoretical. Maybe we'll see this money a decade from now.
Well, it's contracted.
If you look at their next 12-month remaining performance obligations, or RPOs, they experienced 13% growth.
13% growth on future guaranteed money.
No, for the listener, an RPO is essentially contracted revenue that just hasn't been recognized on the books yet because the service hasn't been fully performed.
Right. The check is in the mail, but the work isn't done.
Exactly. Their next 12-month RPO now sits at $7 billion. That $7 billion covers roughly 61% of their entire projected revenue for fiscal 2027.
So the demand signal is just incredibly strong here. In the fourth quarter alone, they won $1.7 billion of completely new work. And look at their trailing 12-month book-to-bill ratio. It's at 1.1 times.
Let's translate book-to-bill for the audience. That means for every single dollar of work they actually completed and billed to the government today, they booked $1.10 of new future work for tomorrow.
Exactly. The pipeline of incoming cash is literally expanding faster than they can drain it.
So the obvious question, the million-dollar question is, why isn't this massive $38 billion backlog turning into recognizable cash right now? Why is the revenue dropping if the vault is completely full?
The delay comes down to immense administrative friction and a massive structural shift in federal procurement policy.
Government bureaucracy.
You guessed it. We have to look at the executive order issued on April 30th, 2026.
Okay.
It's called Promoting Efficiency, Accountability, and Performance in Federal Contracting.
Okay, sounds like a standard government title. But how does that order actually change the game for a company like Booz Allen?
Well, I mean, it fundamentally alters how the government actually buys these services, right?
Okay, how so?
The order directs all federal agencies to massively increase their use of firm fixed-price contracts for new awards.
Fixed price.
And, more aggressively, it forces agencies to actually go back and modify their top 10 highest dollar value existing contracts.
Whoa, they have to rewrite existing contracts.
Yes, converting them from the old-time material structure to new fixed-price, outcome-based contracts.
Let me make sure I understand the mechanics of this shift because it seems huge. Under the old model, Booz Allen would say, we'll give you 50 engineers at $200 an hour for 2 years, and we'll see how far we get on building this AI software.
Right. And the government assumes the risk if it takes longer. They just keep paying the hourly rate.
But under the new executive order, the government is essentially saying, we will pay you exactly $50 million to deliver this specific functioning AI software by December 1st. We don't care how many engineers it takes, figure it out.
That is exactly the shift. They are buying outcomes now, not just hours.
And this transition to fixed-price contracting creates massive execution headwinds, I'm assuming.
Huge headwinds. It's a double-edged sword for Booz Allen. If they execute the project flawlessly, they keep all the cost savings.
Which is exactly how they achieve those target margins well above 20%.
Exactly. But if they miscalculate the engineering difficulty, or if they run into massive supply chain delays with their new edge compute hardware,
they eat the cost overruns entirely.
entirely. The financial risk is completely transferred from the taxpayer to the contractor.
It's like having $38 billion sitting in a trust fund, but the bank suddenly changed all the withdrawal rules overnight.
That's a great way to put it.
They rewrote the terms of release, they changed the entire risk profile, and now they're making you fill out 10 times the paperwork just to access your own money.
And it's not just Booz Allen struggling. The government agencies themselves are struggling to adapt to this.
Because they have to write the new rules.
Right. Federal contracting officers just don't know how to write these complex, outcome-based contracts yet. It's a new skill set for them, too.
So everything slows down.
Everything.
Right.
This systemic uncertainty has caused a sluggish, choppy procurement climate across the board.
Yeah.
Contract awards are delayed, project kickoffs are pushed to the right.
And the administrative conversion of that massive backlog into recognized top-line revenue is just moving at a glacial pace.
Glacial. And when you combine this massive pile of delayed cash from the backlog with the delayed revenue from their new product acquisitions.
Right. Because remember, the $720 million Ultra I&C acquisition doesn't even fully close until the second quarter of fiscal 2027.
Right. So you get a severe timeline mismatch. The losses in the civil sector are hitting the balance sheet immediately today.
The bleeding is happening now.
But the high-margin product revenue and the converted backlog cash won't hit the balance sheet until tomorrow.
And the stock market absolutely hates waiting for tomorrow.
Investors are inherently impatient, right? They see this 6.4% revenue drop today, and they heavily, heavily discount the reality of that $38 billion backlog waiting for tomorrow.
So this temporal gap, this conversion lag, this really sets the stage for a massive showdown on their upcoming earnings call.
It's going to be a bloodbath if they don't message it right.
Which brings us to the ultimate inflection point for the stock. The July 24th Show Me catalyst.
The Show Me earnings call.
Wall Street is currently trapped in a deeply skeptical show me phase right now. Analysts from major institutions like UBS and BNP Paribas are pressing management incredibly hard.
They want answers.
The July 24th webcast is absolutely make or break for the stock.
Institutional investors are walking into that earnings call armed with a very specific decision matrix.
Okay, let's look at this matrix. What are they looking for?
They're looking for two vital metrics to prove that this painful volt strategy is actually working and that the company isn't just, shrinking into irrelevance.
All right, metric 1 on that matrix. Stabilization of organic revenue growth. Management has guided for flat to 4% growth in fiscal 2027.
That 0 to 4% target is absolutely critical.
You have to hit it.
The market needs undeniable proof that the bleeding in the civil segment has finally bottomed out, particularly in the first half of the year, like management suggested it would.
Right.
Furthermore, they need solid evidence that the national security segment is actually accelerating to hit that mid-single-digit growth target to offset the civil losses.
Basically, the top line simply has to stop shrinking.
It has to stop shrinking. If it shrinks again, the market will punish them.
Okay, and metric 2, which is arguably even more important for the long-term thesis here, proof of product-led margin expansion.
This is the acid test for the cognitive triumph pivot.
Is there tangible mathematical evidence that the new proprietary products, the edge compute hardware, the Velox cyber suite, the encryption modules, are generating enough actual profit to bridge that conversion lag?
Investors need to see those profit margins truly expanding toward that promised 20% target.
Right.
They need proof that Booz Allen is successfully adopting the financial profile of a high-growth software firm rather than just suffering the pain of shrinking its traditional low-margin consulting base.
So synthesizing all of our sources today, the financial reports, the massive M&A activity, the friction of the federal backlog, and the Treasury data leak, what is the final verdict?
The final verdict.
Does Booz Allen Hamilton represent a structural value play for allocators at these current multiples?
The verdict rests entirely on your belief in management's ability to execute a profoundly difficult operational high-wire act.
Okay.
If you have a longer time horizon, the bullish case is incredibly compelling. You are buying a dominant, entrenched player in AI and cyber defense, trading at a discounted 10 times forward earnings multiple, sitting on a $38 billion backlog that provides immense downside protection.
The 13% growth in those near-term RPOs really does severely limit the risk of further catastrophic downward guidance cuts.
It does. If they successfully integrate Ultra I&C, navigate the tricky fixed-price contracts, and margins expand as promised. The current stock price is a massive value trap for the bears and a prime entry point for long-term holders.
But the risks are substantial. We need to clearly outline the three primary execution risks that could completely derail this entire cognitive prime transformation.
Right.
Risk number one is what we call the paradox of 2026.
Right. This is the temporal gap we've been discussing. The near-term revenue optics look terrible with that 6.4% drop, while long-term profitability is actually improving, currently hitting an 11.1% adjusted EBITDA margin.
So the paramount risk here is investor exhaustion.
Exactly. Can institutional investors stomach the terrible top-line optics long enough for the product revenue to finally scale?
Because if Wall Street capitulates and just loses patience before the transition is complete, the stock will suffer further, severe multiple compression.
Right. Risk number two, the insider threat contagion risk. We detailed the mechanical fallout of the Treasury data leak and the instant cancellation of those 31 contracts.
The ongoing existential danger is that this fear ripples across the highly classified intelligence agencies that form the absolute bedrock of Booz Allen's national security portfolio.
If the Department of Defense, the CIA, or the NSA begins pruning Booz Allen contracts due to security vetting anxieties, the foundation of the company evaporates.
Because their entire interface moat relies on mission intimacy. A loss of trust physically removes them from the rooms where the decisions are made.
Exactly. And the third and final execution risk, which I honestly keep coming back to, structural skepticism.
Right. Does a 112-year-old advisory firm actually have the operational DNA to successfully manufacture and operate complex hardware?
Buying an edge compute company for $720 million in cash is the easy part. Writing the check is easy.
But actually integrating a physical manufacturing supply chain, managing fixed-price hardware contracts without massive cost overruns, and successfully selling physical processors to the military.
That requires a completely different skill set than billing for consultants by the hour. If they bungle the integration of Ultra I&C, if they fail to deliver on those fixed-price contracts, they will completely destroy the margins they paid so much cash to acquire.
The consultant really must prove it can become the manufacturer.
They absolutely have to.
So, if you are looking at your portfolio today, the ultimate question is whether you believe Booz Allen can survive this margin valley, overcome the massive procurement friction, and emerge as the indispensable cognitive operating system of the U.S. military.
And as you weigh those execution risks, I want to leave you with one final provocative thought regarding the broader technological landscape.
What's that?
Think about the rapid advancement of artificial intelligence right now. As AI becomes increasingly capable of providing basic strategic advice, writing boilerplate code, and performing complex data analytics in seconds, will the legacy trusted advisor consulting model be completely commoditized in a few short years?
Oh, wow.
If a military commander can just ask an AI for a strategy report instead of paying a Booz Allen consultant $200 an hour, then Booz Allen's frantic, painful pivot to owning physical defense hardware and proprietary encryption isn't just a clever corporate strategy for margin expansion.
It might be their only path to survival.
It just might be.
Risk defined, portfolio protected.